One of the important points of this chapter is to look at the goals of the corporation. And I have it in caps to emphasize it. Every finance textbook that you pick up will say that the goal of the corporation is to maximize shareholder wealth. The firm maximizes shareholder wealth by maximizing share price. The firm maximizes share price by accepting all possible positive net present value projects. There are other goals that sound like good goals, maximizing profit or net income, or maximizing return on investment, which is net income divided by assets, or getting a desired growth rate in earnings per share, minimizing costs, maximizing market share. All of those sound like good goals. I mean, if the CEO of a firm announced that our firm is doing that as a shareholder, you'd say, hey, yeah, those sound like good things. And they may be. They may be consistent with maximizing shareholder value, maximizing share price, but they are not necessarily consistent with maximizing share price. For example, a firm could maximize profit for the short term and give up long-term profit that might be more valuable than the short-term profit. Return on investment, well, again, a higher net income is good, but are they using their assets well? You can't tell that it will necessarily increase the share price. It may. I mean, maximizing return on investment is a good thing, but it is not necessarily consistent with increasing shareholder wealth. So again, not bad things for the company to do, but not necessarily consistent with maximizing shareholder wealth. And as far as finance theory is concerned, that is the only acceptable goal of the company, to maximize shareholder wealth by maximizing share price, by accepting all possible positive net present value projects. Now, there are some additional theories. There's stakeholder theory, which says you have to balance the interests of society with those of shareholders. And this theory says shareholders do indeed play a vital role in providing capital, but the shareholders' return on capital should not come at the expense of other important stakeholders. Stakeholder theory says things like your reputation for treating employees and suppliers and customers can increase financial performance by motivating employees to work harder, improve the supply chain, and increase sales. In other words, a favorable reputation can increase value. And there is some support for that over half of the top 20 value creators were also in the top 20 for most admired companies. So again, there certainly may be that connection. The bottom line is that you want to do things where the benefits exceed the costs. Managers should only invest in a capital project if the value of the future cash flow exceeds the costs of that project. That's a recurring theme that you're going to see throughout this class. Projects where the benefits are greater than the costs increase the value of the firm and increase shareholders' wealth. This is for any kind of decision that the firm is making. Physical equipment, building a new plant, buying another company. In all of these cases, you want the benefits to exceed the costs.